second part to the A requirement is to prepare the journal entries to record this acquisition in New Starfish accounts. Now, the acquisition analysis is then quite crucial in drawing up those journal entries because the majority of the journal entries are read straight from the acquisition analysis. Let's look at those entries. Okay, so first of all, we bring in the assets that we've acquired at fair value. So that is the accounts receivable at 56,000. So we're debiting now. The inventory at fair value 39,200. Plant and equipment 140,000. The shares in Sefton 22,500, and the other asset is the goodwill that we've acquired. It's an intangible, and with these business combination entries, it's recorded in the accounting records of the acquirer. Okay, what goes on the credit? The credit side is the consideration that is transferred. So first of all, we create a liability payable for the cash that is payable to Tuna Limited to settle their creditors of 86,700. So we've just calculated that. Then credit for the shares that are issued to the B-class shareholders of Tuna Limited of 108, and credit the 7% debentures account for the debentures issued to the A-class shareholders, 70,000. Okay, so this entry records the acquisition of Tuna Limited in the accounting records of the acquirer, New Starfish. As you can see, all these figures straight from the acquisition analysis. The rest of the entries, first of all, we have to then pay Tuna the cash that we owe them. Not Tuna, sorry, 86,700, and bank or cash is the credit. Then the acquisition related expenses need to be expensed as they're incurred. So that was the 1,600. But the share issue costs is set off against share capital because it basically reduces what we get out of the share capital issuing of the shares. Okay. So according to this accounting statement on financial instruments, the cost of issuing debt or equity instruments should be treated as a reduction in the share capital of the entity. As such, costs reduce the proceeds from the issue. So we treat it similarly in an acquisition. The acquisition-related expenses needs to be accounted for as expenses in the period incurred, so that is the $1,600. It does not form part of the fair value exchange between the buyer and the seller. My apologies. But it's a separate transaction from the business combination. And normally it will not be capitalized but should be expensed. Okay, so that covers all the journal entries to record the acquisition of the assets of Tuna Limited in New Starfish accounting records. Part B then required us to prepare the liquidation the liquidator's cash and the shareholders' distribution ledger accounts for Tuna Limited. So let's look at those accounts. The first account we're going to look at is the liquidation account. Now the purpose of this account is to record the carrying amounts of the assets that were sold, as well as the proceeds from selling those assets. We also record any unrecorded liabilities in this account, and the balance of this account is then transferred to the shareholders' distribution account. Okay, so let's start off. What are the assets that were sold? It's the account receivables, the inventory, and the plant and equipment. And the shares, the investment in Sefton. Okay. Now remember, when we record these assets in the liquidation account, we're now working in the accounting records of Tuna Limited, the company that sold these assets. So we transfer the carrying amounts from these asset accounts to the liquidation account. So on the debit side, it's included at the carrying amount, 56.29. So from the financial statements of Tuna Limited, 167 and 26. Okay. So for accounts receivable, it had a debit balance, so we say debit liquidation, credit accounts receivable, and thereafter the accounts receivable has a balance of 0. So we transfer the remaining balance on the assets to the liquidation account. Okay, second step is then to record the proceeds. I missed something with regards to the plant and equipment. There's another account that needs to be closed off to the liquidation in order to transfer the carrying amount, and that's the accumulated depreciation. So that account is then transferred here. Okay, the proceeds is reflected in the consideration that is receivable from New Starfish. So New Starfish, amount of 264,700. Okay, the following accounts that need to be closed off is the reserve accounts, and any reserve accounts are transferred to the credit side of the liquidation account. Of course, only if they've had a credit balance before the transfer. So 75,500. Okay, we can then balance this account. 40,000 plus 264,700 plus 7,500 gives us a total of 3,8,200. So in order to balance this account, we have we're not done yet on this side, sorry. We also have to record the unrecorded liabilities. So let's just get some space here. Unrecorded liabilities were the premium on the debentures of 3,000, the annual leave payable of 16,200 and the liquidation costs of 5,000. And now we can balance it to 380,200, and it is a debit entry in this account, shareholders distribution, and this goes to the shareholders distribution account. In this case, because it's not an insolvency, we expect it to be a surplus that is transferred to the shareholders. Okay, so let's look at the shareholders distribution account. Okay, first of all, the two share capital accounts is transferred to the shareholders distribution. So that is our share capital for the A shares of 40,000. Then our share capital for the B shares 60,000, as well as the surplus from the liquidation account 78. On the debit side, we record whatever is distributed to the shareholders. So what do they receive in this case? They receive from New Star, as part of the transaction, debentures in New Starfish of 70,000 and shares in New Starfish of 108. Let's see if that adds up. So on this side it's 178, the credit side it's 178. Okay, so that deals with the shareholders distribution account. The last account that we need to draw up is the liquidators cash account, basically where we record the movement of cash as part of the liquidation process. So let's draw up the T account for the liquidators cash account. Okay, so we transfer the cash that was existing in the company of $20,000. We record the cash that is transferred to them by the acquirer of $86,700, and we use this to pay the liabilities from the credit side. Okay, so accounts payable 31, the debentures including the premium 33, the mortgage 21,500, the liquidation costs 5,000, and the other unrecorded liability, annual leave 16,200. So let's see if that adds up. 31 plus 33, 21,500 and 5,000, 16,200 gives us a total of 106,700. So that is the liabilities that were paid. All the, if you look at the statement of financial positions, all the accounts have then been closed off. And on this side, 106,700 balances. Okay, so that then covers the liquidation transactions in Tuna Limited. year after, all the general ledger accounts would have been closed off and the company is ready to be deregistered. Okay, so this is a nice example of a question on a business combination resulting in the acquiree voluntary liquidating after the acquisition. If you have any further questions on this topic, feel free to post them on My Guru, where we'll be able to respond.